Good morning. Welcome, everyone. Thanks for joining us. We're going to get started because we have a lot to cover in just 1 hour to do it. My name is Karen Hartford, and I'm a partner in Verrill's Employee Benefits and Executive Compensation Group. And I'm joined here this morning with Chris Lockman, who is also a partner in our group and has spoken quite frequently at this annual update. So I expect he's a familiar face to many of you, and I won't belabor his introduction, but Chris and I are also joined this morning by the newest member of our group, and that's Bill Jewett, and I'm pleased to introduce him to you today. Bill joined us just in January. He came to us from a large global firm where he was a partner in its employee benefits and executive compensation group. And he has many years assisting clients with benefits issues in mergers and acquisitions context. And Bill has regularly, he has special expertise working with investment managers and asset management clients. Bill is resident in our Boston office, and we're thrilled to have him join our practice, and I'm pleased to introduce him to you today. He's going to cover the retirement plan aspects of our program a little later today. So today's webinar is the third part of the 2021 Labor and Employment Annual Update. And if you've attended the prior two sessions, you'll know that this is the first year that Verrill has done this annual update virtually. And the update has been split up into parts and is being broadcast each month on the third Thursday of the month in 1 hour sessions. The fourth session is coming up in April 15th. And the topic is covering in the workplace, which is a topic that will be related to your diversity and inclusion efforts. The session is going to be presented by two familiar faces from our labor and employment group, partner Tani Alvarez and Liz Johnston. So please keep an eye out for more information on that. It sounds like a good one. I'm going to quickly cover just a few logistics about this webinar. Your lines are all muted to cut down on feedback and interference. That said, we welcome your questions. If you have questions throughout the program, please use the Q&A function that's at the bottom of your Zoom screen. And in order to move along at a smooth clip, we're going to save your questions until the end and then do our best to answer all the questions at the end. And finally, I just want to note that we have already dropped a link in the chat function to the slides from this presentation today and to certificates of attendance for this presentation if for those of you who might be looking for a credit for CLE credit or SHRM credit. And with that, we're going to jump in. If I could have the next slide. So as I mentioned, we do have a lot to cover. And Chris and I are going to cover the health and welfare plan updates and guidance over the past year. And then Bill's going to cover the retirement plan guidance and updates. I am not going to go through all the items bulleted here. The high points are bulleted. I do want to note that one topics that aren't noted here, but we will be covering are from the American Rescue Plan Act, which was passed just last week, exactly 7 days ago. It was signed into law last Thursday. So we will cover the handful of items that were included in the American Rescue Plan Act. Next slide. Okay, so I am taking you back to a piece of guidance that is really background guidance at this point, but it's important background to understand and get grounded. It was jointly issued by the IRS and the DOL in May of 2020, and I'm referring to it as the Outbreak period guidance because the purpose of the guidance was to extend or suspend certain ERISA required deadlines and timeframes during the period of the COVID-19 outbreak. The deadlines that were affected, and in many cases, many cases, these deadlines are still suspended, are, and I'll list them for you, the deadline to elect Cobra, the deadline to pay Cobra premiums, the deadline for a participant to notify the plan of a qualifying event, such as a divorce or disability, the deadline for HIPAA special enrollment, and the deadlines to file claims, appeals, and requests for external review or to perfect an external review. So there's three big categories: Cobra, HIPAA special enrollment, and claims procedures that are affected. This original guidance defined what the term outbreak period meant. And I won't go into all the nooks and crannies of that, but basically it was beginning March 1, 2020 and ending 60 days after the end of the to be announced national emergency. And national emergency is a specific term. In this case, it's a presidentially declared national emergency. Our former president declared the national emergency on March 13th of last year and stated that it began on March 1st of 2020. So here's the kicker. Written into the law that permits these agencies to extend the deadlines that we just talked about, and also in a footnote in the original guidance, the length of time that the deadlines can be extended is limited, and that limit is up to 1 year. So 1 year from March 1, 2020 brings us to, or brought us to, February 28, 2021. So as February 28 fast approached, practitioners and employers and Cobra administrators and TPAs all started to ask, what's going to happen when February 28 gets here? Does every deadline that was suspended start to run that day, or will the deadline be extended somehow? Next slide. So never fear, 2 whole days before February 28, on February 26th, the DOL issued an update to the outbreak guidance. And the updated guidance is what I would characterize as employee-friendly guidance. It makes clear that these deadline extensions must be made on an individual basis, an individual by individual basis, deadline by deadline, rolling extension period basis. The guidance states that with respect to the deadlines that were subject to relief, so that's the Cobra deadlines, the HIPAA special enrollment deadlines, and your claims procedures deadlines, those deadlines are extended until the earlier of 1 year from the date the individual was first eligible for relief, or 60 days from the announced end of the national emergency, which we know is ongoing. It has not, President Biden has not announced the end of the national emergency. So the guidance is also clear that in no case will the period of time that is disregarded exceed 1 year. So one way that I've been thinking about it, I think I saw a headline of an article that I was reading. There was a nod to the Cher song from 1999, If I Could Turn Back Time. So if I could turn back time and add 1 year was the headline. And you really just want to think about this as going back in time, calculating the due date for the applicable person, the applicable deadline, whether it's an election, a Cobra premium, or you calculate that deadline using standard ERISA rules and then add a year. So I've included a couple of examples for you to illustrate that. Can we have the next slide, please? In example number 1, we're going to assume that a qualified beneficiary, a Cobra beneficiary, would have been required to make a Cobra election by May 1st. So their 60 days is up. You get 60 days to make a Cobra election. May 1st, 2021. The new guidance delays, I think we may have skipped, we should be on the slide number 5 with the examples. Yep. So the new guidance delays that election, the May 1, 2020 election, until the earlier of 1 year from that date, which is May 1, 2021, or the end of the outbreak period, which we know is still ongoing. So we're looking at May 1, 2021, when this qualified beneficiary needs to provide a Cobra election. Example number 2, assume that an employee had a baby March 15, 2020, and pursuant to normal HIPAA special enrollment rules, this person would ordinarily need to advise their employer of the birth 30 days from the birth in order to enroll that child. The guidance would permit the employee to notify the employer within 1 year of the normal deadline. So that's by April 14th of 2021, or the end of the outbreak period, whichever is earlier. So again, we know the outbreak period is still going on. Note that I just noted that in the case of a birth or adoption, that's a case that goes retroactive coverage. So could I have the next slide, please? And now I want to cover a new development for you. So this is from Arpa, the law that was passed just last week. That law includes a 100% subsidy of the cost of Cobra, the Cobra coverage cost, the total cost, 102%, including the administrative fee that you're allowed to charge for a Cobra. And this subsidy applies to those assistance eligible individuals who involuntarily lose their job or experience a reduction in hours that cause them to lose their coverage. And they must also be within Cobra coverage period, or still within a Cobra coverage period. In other words, it may have started last year and they have 3 months left in their Cobra coverage period. They are an assistance eligible individual. The subsidy, the 100% subsidy, is in effect for the 6-month period from April 1 of 2021, coming right up in a couple of weeks, through September 30 of 2021. My mention of this Cobra subsidy here is a little bit of a teaser because Chris Lockman is going to cover more about it later in the program, some different details. But the reason that I am mentioning it here is that we've sort of been sailing along over the last year, thinking that those folks who had the outbreak period suspensions for Cobra and have not at this point elected Cobra probably won't elect Cobra. They've taken a wait and see approach, but it's unlikely. We've been thinking it's unlikely they're going to elect Cobra because Cobra is very expensive, and under ordinary circumstances, you have to pay all of your months of Cobra retroactive to the effective date. So this new Cobra subsidy provision in Arpa includes a new enrollment period as well. That's a little bit different, and it permits eligible qualified beneficiaries to jump into Cobra coverage during the subsidy period and not elect retro coverage. They still have that right too. They can still elect the retro coverage and pay however many months of back premiums that they would like to. And maybe there's a fact scenario where someone would want to do that. But suddenly with this subsidy, there becomes much more of an incentive to elect Cobra. And so that's why I'm mentioning that here, because stay tuned and hang on to your seats. I think it's going to be interesting how this all shakes out over the next few weeks. The DOL is expected to issue regulations, and more importantly, and probably more immediately, in the next 30 days or 30 days from the passage of Arpa, the DOL is expected to publish several model notices related to this Cobra subsidy. So you'll want to be talking with your Cobra administrators and see how they're going to deal with these, getting these model notices out to folks. Can I have the next slide? Oh, let's see. I want to go through these frequently asked questions. Are we required to adopt this relief? So this is funny. This question actually relates back to the outbreak period relief and the extensions there for Cobra, HIPAA special enrollment, and claims procedures. Yes, that's automatic extension relief that you're required to adopt it. It automatically applies. It also, this question also just as easily relates to the Cobra subsidy. That's happening. It's you do have to automatically apply the Cobra subsidy as well. So stay tuned again for the model notices on that. What if we already communicated the original extension period? Is that enough? Do we have to reissue revised notices to participants? This is one of those questions that doesn't have an easy answer. It's not a black and white yes or no answer. The guidance from the DOL, which includes a lot of suggestions, specifically states that plans may need to reissue, that's a quote, they may need to reissue amended disclosures if the prior disclosures failed to provide accurate information regarding the time in which participants and beneficiaries were required to take action. So our advice would be to review the disclosures that you've made previously, if any, and if they include what is now inaccurate information or misleading information. For example, some notices actually said that the extension period would end on February 28th, 2001, which was 1 year, or said something similar, like it would end the earlier of February 28, 2021, or the end of or 60 days after the end of the announced national emergency, which wasn't crazy back in 2020. That was reasonable and a good interpretation. So if it says something like that, which is now we know is inaccurate because these deadlines apply person by person, you get your own 1 year extension, then we would strongly recommend that you revise and reissue those notices. But there'll be a few of those, and there'll be a few that are in between. So I think what you need to do is take a look at what you said, and then consider it in the whole context of reasonableness and due diligence. As you'll see from the next question, it's clear from the IRS guidance that what they're most concerned with is participants losing health coverage without being fully informed, or losing the right to pursue a claim that might be a good claim for benefits because they didn't understand or know or have accurate information. So this next question, are we required to provide notice to participants when their 1 year relief period is up? Again, it's this wishy-washy guidance from the DOL that says, what it doesn't say, it does not specifically require you to provide a notice. But what it does say is that plans should consider affirmatively sending a notice regarding the end of the relief period if the plan administrator knew or should have known that the end of the relief period is exposing a participant to a risk of losing protections, benefits, or rights under the plan. So, and going even further, the guidance goes on to say that plans should consider ways to ensure that participants and beneficiaries who are losing coverage are made aware of other coverage options, and they specifically call out their opportunity to use the special enrollment period that the federal government just announced for their marketplace. And for those states that don't use the federal marketplace, most of them, if not all of them, have now followed suit, and there's a special enrollment period. So they're saying you should even consider not only going out to them to tell them their 1-year period is ending, but tell them what other options they have so that they can get coverage. So with this wishy-washy guidance, I will end on a positive note for employers by pointing out that the guidance also states that in the case of fiduciaries that have acted in good faith and with reasonable diligence under the circumstances, the Department of Labor's approach to enforcement will be marked by an emphasis on compliance assistance and includes grace periods and other relief. So bottom line, my advice would be take some action. Talk to your Cobra administrator and your claims administrators and find out what kind of communications have gone out and what can be done to best support your employees. Demonstrate your good faith and your diligence, and you should be in decent shape. And if you have some paper and documentation to demonstrate that good faith, all the better. Lawyers love paper. So the last question here, do the claims procedures extensions apply to retirement plans? Yes, they do. The claims procedures extensions apply to retirement plans subject to ERISA, and Bill will cover a little bit more about that at the end, but I thought that might be a surprise to some people to focus on that because there's so much about the health and welfare plan. Can I have slide 7, please? So this is a little bit about what notices and amendments are required, and the outbreak period guidance provides that a plan or a plan fiduciary will not be in violation of ERISA for a failure to timely under ordinary rules furnish a notice, disclosure, or document during the outbreak period if that plan fiduciary acted in good faith and furnished the notice as soon as reasonably practicable under the circumstances. And the guidance also notes that the use of alternative electronic means of communication are permitted by this guidance. And they even went so far as to say that that would support good faith compliance. So if you're thinking back to last year, when everyone was home shuttered up and you may have been communicating with your employees in any way that you could have to get the word out about various benefit events or exclusions or extensions, then that's good and acceptable under this guidance. With respect to health and welfare plans, there was no specific edict to amend your plan to include those outbreak period extensions by a certain date. So for example, you weren't required to amend your health plan by the end of this year. I'd say it never hurts to do so. We've certainly had employers who might have combined SPD and plan document that they've already updated because that was the easiest way for them to communicate to their employees about the changes. So when and as you are able, it is a good idea. Slide 8, please. And I'm just gonna cover a couple of small, quick changes. I'm jumping out of chronological order a little bit and taking you back to the CARES Act that came out in March of 2020. This law included a small provision that revised the definition of qualified medical expenses for purposes of reimbursement by our pre-tax or tax-advantaged reimbursement accounts, health reimbursement accounts, such as health flexible spending accounts, health savings accounts, health reimbursement accounts, which are the ones that are fully funded by employer money, or the now outdated or defunct Archer MSA, which is really a precursor to HSAs, to include two new reimbursable expenses: over-the-counter drugs without a prescription and menstrual products. The service has over the years waffled back and forth on the eligibility of over-the-counter drugs without prescriptions. So you'll want to take a look at your SPDs and plan documents. Some SPDs and plan documents will include specific language regarding that item. You may want to check that and see if an amendment is needed there. This change became applicable for expenses that were incurred or amounts paid after 12/31/2019. So for 2020, to add this to your plan for 2020 or 21, an amendment is required by the end of this year, and it can be retroactive all the way to January 1, 2020. And if you do add this provision, which I expect that many or most plans would, you'll want to communicate the change to your participants, obviously. Using an SMM or SPD would be best. And could I have the next slide, please? This is my last slide before I turn it over to Chris Lockman. And this is another small change. It was simply in May 2020, IRS Notice 2020-33 increased the carryover limit for health FSAs from $500 to $550 for plan years that begin in 2020. So this is for healthcare flexible spending accounts that include a carryover. Some include a carryover provision where you carry over a small amount of money to the next year and it's not forfeited. Others include a grace period of up to 2.5 months. You can't have both. You don't have to have either. If you have one or the other, it has to be in your plan document. If you do include a carryover, it's now higher, and it's going to be indexed for inflation each year. The other IRS limits are, so you can look for the announcements about that. For the 2020 plan year, an amendment to include that carryover from 2020 to 2021, an amendment is required by the end of this year, and it can be retroactive to January 1 of 2020. And again, you need to communicate this to participants. I included a question here. Is plan sponsor required to adopt the increased carryover amount? No, it's not required. You're not required to have a carryover at all, but you're not required to. This is a maximum. Employers can adopt a lesser amount. And now I am going to turn things over to Chris Lockman to continue and take you through some more of the health and welfare guidance.
All right. Hello again, everyone. I'm going to try to move pretty quickly here through a lot of guidance, and I'm going to start with the Notice 2020-29, which was released this same day as the notice that Karen was just describing. And I'm also going to talk about the Consolidated Appropriations Act, and they're similar because they provide a lot of flexibility for your health and welfare plan. But the key to understanding both is the underlying or the basic general rule that applies when these two special pieces of relief aren't applying. And that's, most of us know this, that your elections under a cafeteria plan to pay for benefits on a pre-tax basis typically must be made prior to the beginning of the year and are generally irrevocable for the entire plan year, unless you, the participant, experiences a change in status event, like the birth of a child, divorce, loss of coverage due to change in employment. or for most plans, not health FSAs, there's a significant cost in the change in the cost or type of coverage that's offered. The IRS Notice 2020-29 and the Consolidated Appropriations Act create special exceptions to this general rule that prohibit mid-year election changes under most circumstances without a qualifying event. So the relief that was available under 2020-29 said for 2020 that you could make an election change in your health plan coverage. You could elect new coverage if you hadn't been enrolled before with the employer. You could revoke your election with the employer and swap it out for a different type of coverage available through your employer. And that means going from a PPO to maybe a lower cost high deductible health plan, or going from family to single coverage or vice versa. And you could also revoke your election for employer-sponsored health plan coverage if you promised or submitted a written attestation that you would enroll or will immediately enroll in other health plan coverage offered by an entity other than the employer, including on the marketplace. The guidance also allowed you to make an election change for your either dependent care FSA or your health plan FSA, healthcare FSA. You could revoke your election, make a new election, adjust your contribution amount up or down on a prospective basis. Finally, it allowed an extended claims period for health and dependent care FSAs that had a plan year or grace period that ended in 2020. So it wasn't available to a lot of plans because most plans are calendar years, and unless you had a grace period that brought you into 2020, it wasn't really applicable to you. The notice contained some other stuff. One of the important pieces was that it made HSA contributions, it made employees eligible to make HSA contributions, even if their high deductible health plan were to allow COVID-19 testing and treatment without a deductible. So it sort of expanded the eligibility for category for HSAs. Next slide, please. So there were a lot of questions about this, and the reason why I'll cover these questions, even though this is stale guidance, is because a lot of the answers bleed through to the similar relief that was offered for the under the Consolidated Appropriations Act, which applies in 2020 and 2021. So first, are we required to adopt this relief? The answer is no. An employer could decide whether or not to amend their cafeteria plan to allow all, nothing, or a little bit of this additional flexibility. Did this allow all employees to drop their health insurance coverage? The answer is no. That question came up a lot, particularly with regard to furloughed employees. No, to drop the coverage under the employer election, you had to make another enroll in another employer option or attest that you would be enrolled in other coverage outside the employer. Could we receive a refund or amount of our amounts contributed to our health or dependent care FSAs? The answer there is no. This is prospective changes only to these FSA contribution amounts. And so if I enrolled for $2,000 in 2019 for the 2020 plan year, and by June I had contributed $1,000, this new flexibility became available, I couldn't reduce my contribution amount to $500 and ask for a check back for the $500 I had contributed but not used. Can we impose limits on the flexibility offered? The answer is yes. And limits were very, very common. Very few employers actually adopted the flexibility to allow mid-year changes in the health plan enrollment because they had this nightmare about a new open enrollment period in the middle of the year, in the middle of COVID. Most employers also limited their FSA changes by date. Either you could make a change, but you had to make it by August 1st, or limited the number of changes. We'll allow you to change your healthcare FSA contribution, but only twice. And then nearly all employers prohibited employees from reducing their contribution amounts below those amounts already reimbursed because they didn't want to have to eat the difference in cost. Is there an effect on HSA eligibility? The answer is yes. If you are going to allow the type of coverage that was going to permit someone to use funds accrued during 2019 to pay expenses through the end of 2020, then that individual would not be eligible to contribute to an HSA in 2020 because those funds were available, and that constitutes disqualifying coverage for an HSA contribution. Next slide, please. So a couple things about notice and delivery regarding this mid-year relief. I implemented it, I want to make this change, how do I memorialize it? The first thing to know is there was no specific advance notice or delivery requirement for this advance notice. In order for the change to be amended to be effective retroactive to January 1, 2020, the guidance requires that employers, quote unquote, inform all employees who are eligible to participate in the plan of the changes to the plan. If you want the relief to be available, you've got to let your employees know what relief is out there. The cafeteria plan, however, had to be amended by December 31st, 2021, so not until the end of this year. And that's regardless of your plan year. And so it's a year basis for the notice from 2020. If it was amended by that time, the relief could be effective back to January 1, 2020. So the note for employers here is don't forget, this is something that maybe you sent a notice out in May or June of last year, and you need to get this amendment done. Don't forget about it before the end of this year. And then finally, what about a summary of material modifications and those things? So the answer is yes. If you made a coverage to your health care or to your health FSA, those are ERISA plans, not your dependent care. And so you must issue an SMM. And that SMM has to be issued within 210 days after the end of the plan year in which you adopted the relief. And so for calendar year plans, that means July 29th, 2022. Next slide, please. Okay, so after this first small batch of relief, we got new relief at the very end of the year in the Consolidated Appropriations Act that looked a lot like the relief from 2020, but slightly expanded and to cover 2020 and 2021. So first off, there was the ability to make a change in your health plan enrollment, your health plan election again, without a qualifying event. This actually wasn't contained in the text of the legislation, but it was offered in Notice 2021-15, which was released in February and provided a bunch of clarifying guidance about the Consolidated Appropriations Act. And the same rule applies. You can add or change your employer coverage, or you could revoke your election for employer coverage if you attest in writing that you would immediately enroll in other health coverage. This is where the Arpa change comes in, and actually Karen did a pretty good job of covering the field. There's a Cobra premium subsidy available now from April 1 to 9/30. And so what Arpa does is it allows employers 90 days after they receive notice of this premium subsidy to elect into a lower cost Cobra coverage option than what they had already enrolled in. This is all about making sure your employees don't lose coverage. Other relief available through the Consolidated Appropriations Act. 2021 mid-year FSA election change. Same kind of as before, you can revoke, decrease, or increase your health or dependent care FSA election for the plan year ending in 2021, regardless of a change in status event. Some new relief, unlimited carryover relief. So for your health FSA or your dependent care FSA, which normally doesn't allow a carryover, you could carry over an unlimited amount of funds as of the end of the plan year ending in 2020 or 2021 to the immediately following year. Very similar relief, also available to health and dependent care FSAs, allowed the extension of a grace period through the end of the year following the plan year ending in 2020 or 2021. So for calendar years, it's like, hey, I have an amount. Normally my grace period limit for my healthcare FSA or my dependent care FSA is March 15th. I can actually continue to seek reimbursement for claims incurred during the entire subsequent plan year. There's also kind of two unique pieces of relief in here. First off is the health FSA spend down. And the health FSA spend down says for participants who are in a health FSA that are no longer in that health FSA at some point during the year, they are allowed to spend down the balance of the account through the end of the year in which their participation ended, including any grace period. This type of relief is already available for dependent care FSAs, so they're just extending it to health FSAs for the 2020 and 2021 plan years. And then there's an increase in the dependent care reimbursement age limit from 12 to 13, and it applies pretty narrowly. for people who were either had a dependent who turned 13 in 2020 or who carried over unused amounts from the 2020 plan year. Okay, next slide, please. So similar set of questions here. And employers are still struggling through some of these. We talk to employers every day about what their health FSA administrator is able to do or willing to do with this new guidance and how they can implement it and then get notice out to employees. Are you required to adopt the relief? No. Simple answer. Can we impose limits on the flexibility offered? Absolutely, yes. And one important piece here is that we have specific guidance now that says, if I want an employee to take advantage of the carryover relief, I can require them to enroll in either the health or dependent care FSA in the subsequent plan year to access their carried over funds from the prior plan year. And that's because there's administrative expenses associated with maintaining accounts for these individuals. Can we allow employees to carry funds over from multiple plan years? The answer is yes. The guidance doesn't care what year the funds were carried over from. If you had leftover from 2019, you didn't spend it, you carried it over, you can continue to carry it over during this guidance. Can we allow retroactive mid-year changes to FSAs? No. The same rule as applied under the prior guidance 2020-29, no refund. Are we required to adopt the unlimited carryover or extended grace period relief if we adopt the dependent care FSA age limit increase? No, those are completely different types of relief. And even though it limits the utility of the dependent care age relief a bit, you're not required to adopt the carryover. Are we required to provide a Cobra election notice if we adopted the health FSA spend down relief? So remember, this is the relief for people who can spend down the balance of their accounts for the FSA. And most people, most plans anyway, you're only allowed to elect Cobra for the remainder of that year anyway. So it's sort of like, well, do we have to offer them a Cobra notice? The answer is yes. And the reason for that is because the spend down relief only allows them to spend down the balance of their account, what they had contributed to that point. Cobra will allow them to continue making contributions and enjoy the full amount that they elected for the year, which is likely higher than what they had contributed to this point. Effect on HSA ability, the same. If you're going to allow people to get expenses reimbursed from for current expenses, get current expenses reimbursed from amounts that were carried over or subject to this grace period, it's going to make them ineligible to participate in an HSA. However, you can allow single employees to opt out to preserve their HSA ability, and it allows for a combined effect. So you can allow people to participate for part of a plan year in a limited scope FSA, so like limited to vision and dental only, or to post-deductible expenses, and for a full open general FSA for the remainder of the year. And that allows people to sort of maximize their HSA eligibility, which is determined on a month-by-month basis, and utilize the carryover as well. The next slide, please. Okay, so notices and amendments here. Very much the same as 2020-29. No formal requirements regarding a specific notice, no formal requirements regarding delivery of that notice. Most employers actually had a situation where they would just allow people to, they'd send a general notice or pamphlet or post something to the internet. And then amendments, they have to be adopted by the last day of the first calendar year, beginning after the end of the calendar year in which the relief is effective. In English, that means if you have a calendar year plan year, which most employers do, and you want some of this relief effective for 2020, you've got to amend the plan by December 31st, 2021. Same thing for 2021. You've got to amend the plan by December 31st, 2022, if you want that retroactive effective date. And last of my slides, please. Okay, other welfare benefit changes. The Consolidated Appropriations Act contained a lot of different relief that went just beyond the flexibility that I described. Really important for employers is the student loan relief. The CARES Act amended the definition of educational assistance to allow employers to help pay student loans on a tax-free basis up to $5,250 for 2021. The Consolidated Appropriations Act actually extended that period until January 1, 2026. And so that if you don't already have a student loan repayment program and educational assistance plan, it might make it worthwhile to implement one, because now you have 5 years where your employees can use those amounts to pay down student loans. And then there's a bunch of really important provisions about surprise billing and transparency that are their own topic completely. I think what's important to know is that you actually, none of this guidance is available right away, except for the mental health parity disclosure requirements. There are new non-qualitative treatment limitations that I think will apply now, and you might have to report up to a state agency, Department of Labor or HHS. And the other things are not effective until at least December of 2021, or in some cases, January of 2022. And I'd be happy to, I think we'll probably do another presentation on those types of things, because it's interesting and will affect the healthcare marketplaces. For now, talk to your insurance company, your third-party administrator, and your broker about how they intend to comply with the new transparency requirements in the Consolidated Appropriations Act. And with that, I'll give it away to Bill.
Thanks, Chris. We're running a bit short on time, so I'm going to spin through these remaining slides pretty quickly. There are a variety of COVID-related provisions that have to do with retirement plans. Some are expired, some are still going, some are lying out in the future, and I'll try to indicate which ones you still need to consider. The place to start is with the CARES Act provisions that are specifically available to people who were affected by COVID. And as you'll see from this slide, you don't have to be very directly affected by COVID to qualify for these provisions. Participants eligible for the special CARES Act provisions, so-called qualified individuals, include individuals who were diagnosed with COVID-19, had a spouse or dependent diagnosed with COVID-19, experienced financial hardship from quarantine, furlough, layoff, reduced work hours. The IRS added pay cut, also delayed or canceled job start, and being unable to work due to lack of childcare. Also in Notice 2020-50, the IRS added that if you're a participant and you have a spouse or a household member who experienced one of these circumstances, you can qualify as a qualified individual and take advantage of these provisions. And a household member is somebody who shares your principal residence. So a participant who has a roommate who had a pay cut during the COVID period could have qualified for these special provisions. Next slide. So the first provision in the CARES Act has to do with distributions. So-called coronavirus-related distributions were available without penalty from defined contribution plans and money purchase plans through December 30th, 2020. And that's right, it's not December 31st, 2020. The statute says these distributions have to be made before December 31st, 2020, so by December 30th. A coronavirus-related distribution is a distribution of up to $100,000 if the plan allows for it. Withholding on these distributions was reduced from 20% to 10%. And in fact, this is voluntary withholding. The participant can say, don't withhold for me. These distributions are taxable over 3 years unless the participant elected to be taxed in 2020. The distributions are not taxed at all if they're repaid, which is to say rolled over to another eligible retirement plan or recontributed to the same plan. And the recontribution, the repayment or rollover can take place over up to 3 years. And just I want to add one point. This is an optional provision. Plans do not have to provide for coronavirus-related distributions. But if a participant who takes a distribution is a qualified individual and would otherwise qualify for coronavirus-related distribution treatment, the participant can elect on his or her tax return to treat the distribution as a CRD. Now, this relief has expired, but the amendment deadline does not arrive until 2022, and the repayment provisions remain in effect for several years yet to come. So if you're a plan administrator, you could be called on to determine whether a distribution was a coronavirus-related distribution and is therefore eligible to be rolled over into your plan. And just a side note at the bottom, if you have a Section 409A deferred compensation plan, somebody who took a coronavirus-related distribution would have been permitted to stop making deferrals to that plan mid-year, even though that's normally not permitted. And there doesn't have to be any coronavirus-related reason. Next slide. The other CARES Act rule was a special rule about loans. We can skip over this quickly because it's expired. The loan limit was raised to $100,000 or 100% of the vested account for qualified individuals. Also, loans that were outstanding as of the passage of the CARES Act could be given a repayment holiday for payments due between that date and December 31st, 2020. Next slide. Just a couple other notes. You may be wondering, how is the administrator supposed to know that the participant's roommate had a pay cut that imposed financial hardship on the participant? Well, the administrator is permitted to rely on participant certifications. And there's a model certification in Notice 2020-50, which we would encourage you to use and rely upon. The amendment deadline, plans, and don't forget your loan procedures, can be amended up to the end of the first plan year beginning on or after January 1st, 2022. And if you're a governmental plan, that's 2024. And at the bottom of the slide, we just have some statistics here on how popular these provisions were. Let me just add one statistic, which will give you an idea. As of the year end of 2020, 5.8% of plan participants in the United States had taken coronavirus-related distributions, which is relatively few, but on an absolute scale, given that there are 100 million plan participants in the United States, we're talking about 6 million coronavirus-related distributions out there. Next slide. The CARES Act also had relief relating to required minimum distributions. Essentially, defined contribution plans and IRAs did not have to make them for 2020. In the middle of the slide, you can see which RMDs did not have to be made. It's permissible for a plan to offer participants a choice whether or not to take the required minimum distribution. And if you want your plan to offer that choice, there's a model amendment that the IRS put into Notice 2020-51, which again, we would encourage you to use. And the amendment deadline is the same as for CRDs and loan relief. Next slide. So if you have a safe harbor 401k plan, usually you're not allowed to change the contribution formula mid-year. However, for 2020, it was permissible during about a 6-month window to reduce your contribution for any reason at all. And I note that this relief has expired. It has not been extended for 2021, so don't try this in 2021. Next slide. There was funding relief for single employer defined benefit plans. Let me skip down to the last bullet in this slide because the first two are largely expired, but I'm happy to receive emails and respond with any questions, respond to any questions you might have. At the bottom of the page, we note that the Biden Coronavirus Relief Act put in place minimum funding requirement relief. Basically, historically, it has been based on a 7-year amortization of your funding shortfall. Going forward, it's going to be based on a 15-year amortization period for your funding shortfall, which means that your minimum required contributions are going to be much smaller going forward. And this is effective for 2022, but you can elect to apply it for earlier years. Next slide. An important provision in the Consolidated Appropriations Act put in place a special rule for partial terminations. What's a partial termination? Essentially, there's a presumption that if you have 20% or more turnover in your participant base during a plan year, your plan has a partial termination, and those who are affected have to be 100% vested in their accounts. The special rule under the CAA provides that there will not be a partial termination in any plan year that includes the period from March 2020 to March 2021 if the number of active participants in the plan at the end of the period is at least 80% of the number at the beginning of the period. So just to give you an example, if you want to avoid a partial termination, but you're planning a layoff for next week, you might want to consider pushing the layoff off into April if that will enable you to make sure that your participants at the end of March 2021 are at least 80% of your participants in March 2020. Next and last slide. There's been IRS relief for certain administrative matters. Karen covered the extension of deadlines and the loosening of e-delivery requirements for certain notices. That applies to retirement plans as well. Claims procedures, as Karen noted, the deadlines are extended. Verification procedures for certain plan elections have been loosened. You can do a spousal consent by Zoom if your state notary laws permit it. If the laws don't permit it, you can still have a plan representative witness a spousal consent by Zoom, and there's a whole procedure for producing a photo ID on camera. And you can look in IRS notice, I think it's 2020-41 if you want the details of that procedure. And finally, if you are late depositing contributions or loan repayments and the failure is attributable to COVID, there won't be any enforcement action if you and your service providers act reasonably, promptly, and in the interest of employees to comply as soon as administratively practicable. And that's it for retirement plans. Karen and Chris, we may have some questions in the chat or in the Q&A.
I'm happy to jump on them just in the interest of time, because I noticed there's some questions that came in. So the first question that we had was, what did I just say about carriers taking care of 100% of the new Cobra subsidy? And the answer is, the way that the legislation is drafted, it says that the person to whom premiums are payable is the entity that's eligible for seeking the reimbursement of the amounts of the covered subsidy extend to employees who are laid off or involuntarily terminated. There was another question that's actually very good, sort of long, complicated question about another provision in Arpa, which eliminates, to a degree, the earnings threshold for subsidized premiums in the health insurance marketplace. And the question says, if you're an ALE under the Affordable Care Act, meaning you're subject to the employer mandate, what's the likely impact on you if you have a lot of employees opt out of your coverage and enroll in marketplace coverage because they might be newly eligible for a subsidy? The answer is probably no impact. And the reason is your liability for a penalty under the Affordable Care Act, it only exists if you don't make an offer of coverage that is both affordable and provides minimum value. So long as you make the offer, you're compliant. And affordability is pegged to, different safe harbors regarding the amount of W-2 rate of pay or federal poverty line. So it won't affect directly the affordability.
Hey, Chris,
yeah.
I just wanted to go back to that Cobra question because I wondered whether the audience member may have been referring to the subsidy relief. So in order to get the subsidy for the 100% subsidy through Arpa, it is limited to involuntary terminations.
Ah, okay.
I wondered whether they may be referring to that as opposed to just a general Cobra question.
Right.
And so if that's the case, that's true. It's not for, so if someone voluntarily resigns, that the subsidy does not apply. You have to
Oh,
be
okay.
involuntarily terminated or involuntary reduction in hours.
That's a good clarification. Thank you.
Mhm. Okay, and I think there's one more question that's might be
Yeah.
directed to Bill.
One other question, has any consideration been given to providing additional COVID-related distributions or loans for retirement plans? It's a good question, and the answer is no. This does not seem to have been part of any legislation going forward for 2021. I think the position is that people who wanted to take advantage of these provisions have already taken advantage of them. Any other questions, Chris and Karen?
I
Oh.
don't see any more.
If you do have further questions, our contact information is there on the last slide, and we'd be happy to respond.
Thank you.
Thank you.
Thanks.